Good morning. It's been another busy morning so far, especially for currency markets, especially for the pound. And yet again, obviously after last Thursday's discussion around the Bank of England, that vote that we saw 5-3, that surprising vote that we saw come in 5-3, three members of the MPC voting for a rate hike in the UK. Now that caused quite a big move, caused some upside into the into cable, into those sterling currency pairs. Remember, any sort of hawkish statement, anything that pushes the idea of rates moving higher from these lower points is positive for the currency, not necessarily for the equity markets, but it's positive for the currency. Now that's why this morning we've seen such a big sell-off in the pound, so cable's lower, and we've seen cable and euro sterling push that slightly, that little bit more higher, and that's down to what Mark Carney has said. Now, after Thursday's rate decision, he was supposed to be speaking at Mansion House, the Mansion House speech. Now, that didn't happen on Thursday. That happened this morning at 8:30. And within that speech, actually, Mark Carney spoke some sense about these rates. Now, on Thursday, there was really across the country, everyone was particularly surprised because just the day before, we'd seen two numbers show real negativity about the UK economy. We saw the fact that wage growth was just at 1.7%, missing expectations to the downside pretty aggressively. Expected a rise of 2.3% there, and we got that 1.7%. Now, that is poor wage growth, the lowest figure for a long time, and it just shows that those stagnant wages are really affecting what's going on in terms of consumer spending, because we've got retail sales numbers a little bit later on throughout the week as well, and they showed that there was that negativity. But it's not just that wage growth, that stagnant wage growth, which is the issue. It's the inflation. Inflation has moved to 2.9%. Now, Mark Carney himself at the inflation report a couple of weeks back said that he expected for the whole of 2017, by the end of the year, that we would see inflation at 2.8%, but we are in June and we are already at 2.9%. But the issue is, when you see this vote of 5-3, three members voting for a rate hike, they're voting for a rate hike in a situation where we're currently seeing wages at 1.7% and inflation at 2.9%, and those two things do not go together when the divergence is that big. Now remember, in the UK currently we have record debt, including mortgages. The average household debt in the UK is £53,000 per household. Even if you take out of the mortgages from that, it's still at £13,000 per household. So that's a massive amount. I mean, it's the highest it's been for a number of years. So this is a real worrying point for the UK economy, and that's exactly what Mark Carney said today. He said where rates are at the moment is exactly where we need them to be in the current climate. No monetary policy is going to bring those wages higher. The wages need to come higher on their own, and it was going to be a gradual move to the upside, very much like the inflation one. But inflation is starting to outpace that, and it's outpacing it by so much more now when it's up at 2.9% and the wages are so low, down at 1.7%. But Mark Carney didn't just say it was wages and inflation. He told us about Brexit, of course. The issue with Brexit being is that nobody knows what's going to happen. We don't know what's happening within the talks, and we have no idea what Brexit means for the UK after the talks. We have to just wait and see. Now, those Brexit discussions, yes, they started yesterday, but economically, we have no idea what that's going to mean for the market. So the fact that we have that growing uncertainty around Brexit and this huge divergence between wage growth and inflation means that the rates at these lower levels is exactly where we need them at the moment, and that's exactly what Mark Carney said today. Now, the movements in the pound were particularly aggressive, and we fell lower. In fact, we fell quite close to that election low. Now, obviously, after that election, that surprise election result 2 weeks ago, that we really did see that quite aggressive move to the downside, and that move today in the pound has seen us come and almost retest those levels. We got down to lows of 126.70, 126.67 or so, and that post-election low is down at 126.35. So that post-election low is now the big area of support on the downside. That's where we need to look out for, and that's the big area that's going to be in focus. We have retraced some of that so far this morning, but the difference is we are going to have to focus in very much on that level. Now, we're seeing some big moves elsewhere, and again, in terms of today, it's a fairly quiet day. It's been quite a quiet start to the week in terms of macroeconomic data, but with lots of speeches from Mark Carney. We've had the Fed's Fisher, we'll get the Fed's Kaplan later today as well, all with a focus on monetary policy, so that's going to cause some movements. And we're actually seeing movements in gold yet again. We've seen that market really turn around from this low point. And in the gold market, we spoke about this before, the fact that 2017 has seen almost a return of the gold acting as a safe haven. For a long time, people didn't want to associate gold with that old-fashioned safe haven term. But now in 2017, with so much in the way of geopolitical stories and issues coming out of the White House, Brexit, all of those stories, it means that a lot of the safe money does get put into gold, and that's what we've seen. However, last couple of days, back end of last week, we've seen that fall quite aggressively. We have held up at the weekly pivot point, the S1 level. Now, that's been a particularly big level. That's coming in at 1242. Now, 1242 around 1242.70 or so on the downside. But then just below that 1242, we've got that 200-period moving average, as well as the key important trend line down at 1231. They're the big levels for gold. But we are seeing that turnaround at the moment. And the interesting thing is whether we can sustain that turnaround at that S1 level, or whether the market's going to see some kind of turnaround on the opposite trend line, which is coming in play, and see it lower again. That will yet to be seen throughout today, and when the US session opens, that's going to give us a little bit more information about that. But for now, this morning, it's very much a focus on the UK. It's very much a focus on Mark Carney and what he said. And finally, someone who's starting to speak some sense around these rates and the fact that the UK just cannot stomach a rate hike at the moment.